Hello, everyone, and welcome back. Netflix has just released its third quarter earnings for 2025, and the report is a classic tale of two stories. On one hand, we see robust revenue growth and a booming advertising business. On the other, a significant earnings miss that sent shares tumbling. So, what exactly happened, and what does it mean for the company's future? Let's break it down. Netflix is a dominant global streaming entertainment service that has fundamentally reshaped media consumption. The core of its business model is a subscription-based platform offering a vast and diverse library of content, including original series, films, documentaries, and licensed titles for a monthly fee. Initially a DVD-by-mail service, the company's pivotal shift to streaming propelled its growth, allowing it to amass over 270 million paying subscribers worldwide. Its strategy heavily emphasizes massive investments in proprietary content, known as Netflix Originals, to differentiate itself, reduce reliance on third-party studios, and attract and retain a global audience. While the streaming service is its primary revenue driver, the company also operates a smaller legacy DVD business and explores adjacent revenue streams like mobile gaming. Netflix generates revenue primarily through its tiered subscription plans, which vary in price based on video quality and the number of simultaneous streams, and it has recently incorporated an ad-supported tier to capture additional market segments.
Let's start with the top line. Revenue. Netflix brought in $11.51 billion for the quarter, a solid 17.2% increase from the same period last year. This was essentially in line with Wall Street's expectations, showing that the core business of generating sales remains strong. However, the real story this quarter is on the bottom line. Adjusted earnings per share, or EPS, came in at $5.87. This was a clear miss, falling well below analyst estimates of around $6.94 and even Netflix's own forecast. So why the discrepancy between strong revenue and weaker-than-expected earnings? The primary culprit was the operating margin, which came in at 28%, below the company's guidance of 31.5%. This was almost entirely due to an unexpected $619 million tax expense related to an ongoing dispute with Brazilian tax authorities. Despite this hit, it's not all bad news on the financial health front. Net income still grew 8% year-over-year to $2.55 billion, and perhaps more importantly, free cash flow surged 21% to $2.66 billion, demonstrating Netflix's powerful ability to generate cash. The revenue growth was broad-based across all regions. North America and EMEAA both saw high double-digit growth, while Latin America and the Asia-Pacific regions also posted strong gains. This quarter also underscores a major strategic shift that Netflix has been communicating. The company is moving decisively away from emphasizing subscriber counts and is now focusing investors on key metrics like revenue, margins, and the growth of its advertising tier. This is a sign of a maturing business prioritizing profitability over pure user growth.
Management, including co-CEO Ted Sarandos, was quick to frame the Brazilian tax issue as a one-time, unusual cost that is not expected to impact future margins. Their commentary remained firmly focused on the future, highlighting the expansion of the ad-supported plan and the use of AI to enhance content creation efficiency. Looking ahead, Netflix's guidance suggests confidence. For the critical fourth quarter, they've projected revenue of $11.96 billion, slightly above Wall Street's estimate. They also raised their full-year revenue outlook, signaling that the fundamental growth drivers, price increases, subscriber revenue, and a rapidly expanding ad business, are firmly in place. The immediate market reaction was negative, with shares falling 5 to 6% after the report, directly reflecting the earnings and margin miss. Analysts seem to view this quarter as a speed bump rather than a roadblock. The prevailing sentiment is cautious optimism. While rising costs and competitive pressures are noted concerns, the strong growth in advertising and the company's disciplined global content strategy are seen as powerful engines for near-term growth. In summary, Netflix's Q3 2025 presents a nuanced picture. The company successfully grew its revenue and demonstrated incredible cash flow generation, proving the strength of its business model. However, a one-time tax charge exposed it to volatility and caused a significant earnings miss. The key takeaway is this. Netflix's long-term growth story, particularly around its advertising business and international expansion, remains intact. But this quarter is a stark reminder that even a streaming behemoth isn't immune to unforeseen challenges. The path forward looks bright, but it may not be perfectly smooth. A persistent issue is emerging: margin pressure. Netflix has officially guided that its full-year 2025 operating margin will be slightly lower than previously projected, coming in at 29% versus the earlier 30% target. Why? The cost of doing business is going up. We're seeing increased spending on content amortization. That's the cost of their massive library of shows and movies, as well as higher marketing costs to support all these new releases. The central challenge for Netflix now is balancing this intense revenue growth with sustained high profitability. Of course, spending all that money on content is non-negotiable because of our third challenge: intensifying competition. The streaming landscape is more crowded than ever. Netflix isn't just fighting Disney Plus and Amazon Prime Video anymore. It's also competing for viewer attention against YouTube and a wave of new platforms focused on short-form video. This competition does two things. It puts pressure on subscriber growth, and it forces Netflix to continuously spend more just to maintain its leadership position and keep its content fresh and engaging.
This leads us to a more subtle but crucial challenge for investors: a shift in how Netflix reports its performance. The company has decided to stop disclosing quarterly subscriber additions, choosing instead to emphasize revenue and its advertising business. While this makes sense for a maturing company, it has created uncertainty. For years, subscriber growth was the single most watched metric for Netflix's expansion. Without it, investors are having to adjust to new key performance indicators, which can make it harder to gauge the underlying momentum of the business. All of these factors culminate in the fifth and perhaps most critical challenge: Netflix's premium valuation. Even with recent volatility, Netflix trades at a high price-to-earnings ratio compared to its peers and the broader market. This high valuation means there's very little room for error. The market is pricing in near-perfect execution. Any sign of a slowdown in growth or another margin disappointment could make the stock particularly sensitive and vulnerable to a sharper pullback.
The overall consensus from analysts is a moderate buy. Let's break down what's behind that rating. Out of 24 analysts tracked, the sentiment is broadly positive but with clear caution. 17 recommend buying the stock, while 6 suggest holding, and only 1 advises selling. When it comes to price targets, the average sits in the range of $1,340 to $1,350. With the stock recently trading around $1,230, this implies a moderate upside potential from current levels. But digging deeper, we see a wide range of opinions. On the bullish end, firms like Robert W. Baird and Wells Fargo have price targets as high as $1,500 and $1,560, signaling strong confidence. Seaport Global and Needham are also in the buy camp, with targets around $1,385 and $1,500. On the more cautious side, we have Goldman Sachs and Citigroup. They both have a neutral or hold rating with price targets of $1,300 and $1,295, respectively. Their view is that while Netflix's fundamentals are strong, there are valid concerns about its current valuation and near-term pressures. So, what are the key factors driving these analysts' opinions? On the positive side, analysts are applauding steady revenue growth, driven primarily by strategic price increases and, importantly, the successful expansion of its advertising-supported tier. This new revenue stream is seen as a major long-term growth driver. Strong global engagement. Netflix continues to command a massive and highly engaged subscriber base worldwide, which is the foundation of its business. However, there are significant challenges creating headwinds. Margin compression. This is a key concern. Rising content costs are squeezing profitability. This was highlighted by a recent earnings miss, which was also exacerbated by a one-time tax dispute that hit the bottom line. The competitive landscape. The streaming space is more crowded than ever, and the constant need for heavy content investment to stay ahead is a persistent challenge. Wall Street's message on Netflix is one of cautious optimism. It's generally rated a moderate buy with clear upside potential, but that potential is tempered by earnings volatility and intense competitive pressures. The story is no longer just about subscriber growth, it's about profitable monetization, and that's the new challenge Netflix is navigating.